I think it's time to have a bit of a discussion on how real estate is affected by interest rates. I keep hearing a lot about this from news outlets, from realtors like us, people just commenting on rates. Why does it matter? Historically and theoretically, as the Bank of Canada increases the bank rate, which in turn affects the prime rate of everybody that's on a variable rate mortgage that is tied to that bank rate, it affects their affordability. So let's use a simple example. Let's just say you had the ability today to qualify for a mortgage of $500,000. That affects what you can buy because you're limited to that based on current rate. When you pair price of the mortgage and that rate, you get a mortgage payment. You know exactly what you'll be paying each month. And that tends to define what you can afford, where you're comfortable shopping. So like if you're in the rental side and you got a budget of $2,000 a month, so you're very clear, $2,000 a month is what I can afford. Probably get paid monthly. That's how you budget. Same concept applies if you own. You might also be thinking monthly budget. How much can I afford? If you're looking at a fixed budget for what you can afford, the rate's going to have an impact as to how much of that budget is taken from interest, and therefore leaving whatever's left over for you to pay towards the actual mortgage. As the interest rate increases, your mortgage amount is going to decrease if you're keeping your monthly payment fixed. The same thing happens in reverse. As rates fall, it means that I'm paying less interest each month. Then maybe I can afford to tack on a little bit more on my mortgage amount because I'm still being true to that monthly cost, the monthly budget. So you see a lot of realtors that are talking a lot about interest rates right now. Why? There's been several rate cuts. Past few years, we saw significant increases in that bank rate. Like it was relentless. It was the quickest pace in history and the highest change in quite some time. It made things very difficult. If you had locked into a variable rate mortgage years ago, all of a sudden this happens and you're tied to that variable rate. Holy smokes, it's not comfortable. Okay, because you made budgets based on certain expectations. Some of it could be buyer beware, but a lot of it was the Bank of Canada governor came out and said, we are not going to raise rates for a very long time. So he said that, which gives people reason to believe that. And in the end, they just backtracked on that. Total disaster. So now you see rates coming down. When rates were going up, yes, absolutely without a doubt, the price of properties was on the decline. It was very punitive. So now that rates are coming down, what's going to happen? Again, theoretically and historically, it should increase the buyer pool, increase demand, which should impact prices. Will that happen? Who knows? Theoretically and historically, reduction of rates increases price. That's just how it works. This time might be different. And I know you heard this before. Many of us say this time is different. Yeah, but this time actually might be different. When rates were high, there were just no sales. There was some money that was being lost on the real estate side when sales did happen, but a lot of sellers resisted selling. So there's not a lot of data from which to pull from to make assumptions as to what to project going forward. I am not going to pretend to know the answers to it. Again, theoretically and historically, reductions in interest rates, the Bank of Canada rate, has led to increase in prices. So if you're going to follow that mantra, herein lies an opportunity. The opportunity is we expect rates to continue to fall. In fact, every documented business article in the past few months is continuing to say the same thing. And now that the Americans have dropped their rates as well, it gives us even more of a break to do it a little bit more aggressively. So if we believe that rates are going to fall, what's to stop us from acquiring real estate today with the expectation that rates are going to fall, which should lead to price increases? Why can't I buy something today and just close in 3, 4, 5, 6 months when I believe prices will be higher because of that relationship? It's a strategy. I don't know what's going to work, but it is a certain strategy that might make sense for you. So anyways, I'm here to talk about it with my wonderful friends on that side of the screen, here to help you get wealthed up.